for my Canadian friends. Good morning, everybody. This is Dennis Wilburn with the Active Trend Traders. Welcome to the How to Make Money Trading Stocks webinar that we do every Friday at, or most Fridays at 10 a.m. Joining me today from Dallas, Texas is my research partner, Mike Traeger. Hi, Mike.
Hello. Good morning. Well, almost afternoon here, but hi. Hi. How you doing?
And then join us from Austria is Michael Bishop. Michael, how you doing? So Michael is with us, guys. So we're going to be asking him a little bit about what this sell-off flavor tastes like over in Europe. I want to remind everybody that all materials presented are for training purposes only. Traders should always paper trade any new method prior to the risk of their personal capital. At the Active Trend Traders, I'm very much about coaching, teaching, this type of stuff. We did a presentation this last Tuesday night that was about how to, look for the proper setups to the downside. And right now we're in a posturing position. We're kind of like in a holding pattern, waiting for those patterns to set up. They have not set up yet. This week we'll be talking about dynamic compounding effects, and that's going to be highlighting one of the features of the early warning alert system, which is multiple compounding periods during a single year, and how that can really drive returns very nicely. So that's what the premium members in the Active Trend Trading will have on Tuesday night. So
you know what Warren Buffett says about financial compounding?
What does he say?
Eighth wonder of the world.
Eighth wonder of the world. I thought it's absolutely true. I mean, in this latter part of 2015, I really got plugged into some, aspects of portfolio building and all that kind of stuff, thanks to one of my friends, Lee Tanner, who's up from Petaluma, and it really hit me square in the face. And oftentimes the entities out there that teach trading, they do a very good job of teach trading, but it's typically teaching, you celebrate the onesie and twosie wins, and they really don't get into the concept of how to develop and build a strong portfolio. And I have finally been convinced that is the way that a person works on developing wealth for the long term. Now, of course, wouldn't you know it, as soon as we come to that, agreement on that, the market does what it does, and right now the market is not favorable to portfolio building. In fact, last week we were talking about, last week was one of the best first week sell-offs of all time, extremely oversold. And as you know, if you've been watching the market this week, we went from extremely oversold to even more extremely oversold. And the question I kind of leave on the table for today is, one, will the indices see a bear market in 2016? How significant is this sell-off? How is it different from, the short and shallow corrections we had since the recovery back in 2008, 2009? Because we see with the S&P is in fact seeking new lows. NASDAQ, an extremely wild ride. I mean, the NASDAQ yesterday, for the range of its move from low to high, from low to high was a little bit over 4%. If you trade the leveraged index ETFs, TQQQ in this case, that was like a 12% range on that. And the thing about it is that it went up 12%, but you saw where it opened today. It lost over, well over 3/4 of what it gained yesterday, and is now, even moving down further. The Russell is in a defined bear market. We entered that about Wednesday of this week when it dropped below 20% below its high in 2015. David Trujillo says that it's the worst January sell-off in history. And there's a lot of questions, and I'll throw this open to both Mike and Michael. The sell-off that we had back in 2007 and also into 2008, which was the last real, last significant bear market, things have changed now. China has become a much bigger player in the world, and much more forceful. And as you're aware, the U.S. has perhaps become less of a world player, and kind of like has become a status quo kind of country. But from where I'm sitting and where I'm looking at is because of the weaknesses in the overseas markets and the weakness under the hood of the U.S. stock market, this could be a really ugly correction. I mean, we could see some lows that perhaps were down in the 2008 levels. And so what do you guys think about that, Mike and Michael? Mike first.
That's me.
Yeah. Well, yeah, either. Okay, Michael, go ahead.
Okay. Well, what should I say? I think what you clearly see is that all the markets are more and more correlated. So
yeah.
there are less and less places to hide. Then I think the second thing is that this time it's not really the financials that are the weak part. It's maybe the disaster in oil price.
Yeah, without a doubt.
Or I think it's more and more the basic concept is, are the big investor community, how much money are they willing to buy assets?
Yeah.
And currently they think they paid too much for, and basically for everything.
Yeah.
And so asset prices go down.
Yeah, very interesting.
So it's difficult to.
Yeah.
So I would more concentrate in such a case on the technicals than the fundamentals.
Right on. So Mike Traeger, what do you think? Mike, are you there?
Can you hear me now?
I can hear you now.
Oh, sorry. I think I had myself muted. I tend to look at things from a longer term perspective, and I've been talking for months, several months, about valuations, reversion to the mean, how overblown and hypervalued the market had become, and I think now it's all coming home to roost. Now,
yeah.
you can look at China, or you can look at the oil prices and say, well, that's the primary catalyst that's triggering it. And that's probably true. But there were certain underlying fundamentals in the market that were way out of kilter for way too long, before the past 2 weeks.
Mm-hmm.
And and I also think the central banks, the global central banks, have been propping the markets up, and I truly believe the investing community has kind of lost faith and stopped assigning any credibility to them.
Right on.
And this is the end result of it. There's more selling to come, and the price target I would be looking at for the S&P. If you go back and look at longer-term charts back to about 2000, the S&P had basically over a 15-year period traded in a big range, and the area around 1560, 1570 was the upper end of that range.
Mm-hmm.
And it's never really been revisited since
Right.
It broke out of that range. I think that's where we're headed.
Okay, cool. David also asked, was this expected in Europe, and was the rest of the world pretty much in recession before all this started happening? Now, I want to put a little bit of a caveat on that, on what was going on. Is Mike Traeger and I have been talking about a topping process for probably about the last 12 to 15 months. As we've gone into this, rounded topping type, rounded top on the S&P and a close to a rounded top on the NASDAQ. And so we've been watching this top develop now for, going on, 15, 16 months. And so, but it is, a great question. Was this expected in Europe? And was the rest of the world already in recession? And the last hangers-on in the American or the U.S. stock market finally started to let go of the ledge and fall?
You know what? I think it's a really good question and well worded, because I think that is, to a large extent, very much what's going on. Good portions of the rest of the world were in recessionary conditions, before the markets here started letting go, and even portions of the U.S. economy were in recessionary conditions. Before the past couple of weeks. I mean, energy is the most obvious example.
Yeah.
The railroads haven't been doing well either, and that has to do with everything that's been happening with commodities and energy.
That's right.
In inventories, business inventories and wholesale inventories, ratios of inventories to sales have been at recession-like levels for months in the U.S., which tells us that, that they're stockpiling inventories, stuff isn't selling, and so manufacturing's going down because they don't have the demand to keep stuffing the inventory channels. And all this stuff has been going on in the background. We've spoken repeatedly over months about a handful of stocks holding up the cap-weighted indexes.
That's right.
And now, that's all finally giving way. So I think the question and the way it's worded is very much what's happening.
Right on. So, Michael Bishop, were you expecting this to what's been going on right now? Were you expecting it in Europe?
Yes and no. I mean, it's. I think the situation in the US is easier than in Europe, because in Europe we had extremely different situations. I mean, Germany is really a strong growth. Once again, they will have surpluses in the government budget, and they are with the weak euro, they are basically, the economy has getting boosted, and on the other side, basically nothing, no stimulus, nothing helped for the parts of Europe.
Okay.
And I think what was really interesting to see is I attended quite a couple of institutional professional conferences before Christmas, and basically the official message all over there was 2016 is a year to invest in Europe. So basically US won't do that bad.
Okay.
And Europe will be Europe is the place to be. But if you talk to the people, what do they do with their own money, how they are positioned, etc., you saw that basically they are not that optimistic as they talk.
Ah, okay. Yeah, well, I mean, it's amazing that a professional financial guy would be overly optimistic in what they're talking about. No,
I can't hear you.
I'm saying, huh? I'm saying that with tongue in cheek. the financial guys can be, it's kind of funny. I saved the papers from the beginning of the year 2016, the Barron's and the Wall Street Journal and the IBD, and it's really interesting to go in there and see what the expectations, or at least what's being promoted. So as we go into this 3-day weekend, the market will be closed on Monday for celebration of Dr. Martin Luther King's birthday. Right now, there are no buying catalysts. We see the institutions not buying the dips like they were on the way up. And now what they're doing is they're selling, some people call them the rips, they're selling the wedge ups. Be very careful, watch out for and I'm just calling this the relief rally is overdue bias. That can turn out to be a bull trap. Because what oftentimes after we've had a nice little sell-off, we may fail to recognize that the character of the market has now changed to favor the downside. And so we can try to jump too early into particular trades, and there is nothing wrong with that, because we know at some point we are going to hit a bottom and get a nice little relief rally. But if you are trying to do, I'm not saying pick the bottom, but where there's a solid place where you would expect a rebound, please go in with not full positions, just use it as little trial trades. And finally, there has been no capitulation yet on either a daily, a weekly, and or a monthly chart. And when I say capitulation, I'm talking about a real hard sell-off. We'll take a look at it on the charts here shortly. But where prices are just driven down, and then finally it hits a level of support, and that's when the buyers start coming back in. The sellers are exhausted, and so that's what I'm seeing in the market right now, guys. So last week, the stocks above the 20-day moving average were down here about 14, almost 15% of them above the 20-day moving average. Moving into, oh, look, it dropped. Matter of fact, it dropped 5 days in a row. We had a little bit of a rebound, but now we're getting down into when it gets interesting time. Doesn't mean we're going to go immediately into a real strong rally, but we know that as this particular indicator continues to move down, at some point it can't go any lower. I mean, it can go to zero, of course, zero stocks above the 20-day moving average on the NYSE. That is an extreme rarity. The lowest I've seen it in the years that I've been looking at is I think we saw it, Mike Traeger. I think we saw it down to about 2% at one time. And
yeah, it can't go much lower than 2, can it?
No, it can't. And
I mean, I'm looking at it right now. I mean, I'm on the with the live feed on the page. It's down to about 5.
Oh wow. Okay, so it's even fallen.
And I think what's even more remarkable is there's about a 20-minute delay on that reading. So
right.
The percentage of stocks below the 200-day moving average, which has been remarkably negative for a long time, is down to about 15.
Wow.
I mean, these are really, truly oversold conditions.
It's almost like it is like a what do you call it, the 50-year flood stage. I mean, that seems like we're approaching those kind of things. But we're keeping an eye on this. We do have a standby trigger going on the early warning alerts. But guess what? Like we said, we've had no capitulation and no indication that the market is ready to even rebound a little bit. And I'm certainly not going to put out any type of alerts until the market kind of proves itself a little bit more. One of the other things, Mike Traeger, and both Michaels, I think you'll really enjoy this. I went back and I grabbed now this is a monthly chart. And so this goes all the way back, the same thing, percentage of stocks above the 20-day moving average on the NYSE. Now, and I'm taking a look here. Now recognize the month of January is not over yet. and we really don't know what happened back here in 2007, 2008, 9, where this indicator dropped very low for the month. So we don't know if we're going to get a rebound or not. But I found it very interesting that at least midway through January, this is hitting lows that this indicator is not seen in this case, 10 years.
Yeah.
And I threw up, and I, not because I was ill, no, I threw up the chart that went back 25 years. Well, and actually, this stops calculating about 2002 time frame. So from 2002 to 2016, so that's approximately 14, 15 years, 14 years. This is, you know, if we were to, the month was to finish today, this would be a brand new low on this particular indicator. And I don't know exactly what to make of that. Mike, you got any insight on that?
Well, again, you know, short term things are pretty oversold, and that doesn't mean that they can't get more oversold.
Right.
Because I thought they were pretty oversold a few days ago.
Yeah, I know we did. Yeah.
We're getting more selling now. So you know what this is saying to me is that we're getting set up here for at least a short-term relief rally.
Yeah.
But we're now in a downtrending bearish market, and you know relief rallies are going to happen, and they can actually be kind of significant, you know, as price, you know, reverts back to, you know, the shorter and the intermediate term moving averages.
Yeah.
But they are nothing more than relief rallies before the downward momentum, you know, starts kicking in again.
Yeah, and so far the relief rallies, just, you know, in case anybody missed them, the relief rallies, well, have been like 1 or 2 days. I mean, that's what we had kind of like the last couple of days, or before yesterday, we had a little bit of a bounce up, 2 days, bam. Yesterday we had what appeared to be a rally attempt, and it was wiped off the chart today. So
the overnight market was a catastrophe.
Yeah.
The future state just went down basically with no single uptick.
Yeah, it was amazing, and that's one, Michael, and I'm going to put out something maybe this weekend that kind of takes a look at that for the pre-market, and what's been happening, and what is making the market a little bit is very challenging to trade per se, is a lot of the movement that's been going on is happening in the after hours time frame. And I was watching that and looking at the after-hour chart that I have up on my intraday charts, you know, my 1 hour and half-hour charts, and I was noticing that over the last several weeks now, most of the moves have been taking place during the after hours, and therefore you either got a gap up, gap down, and there's been a you know, something would gap down, a gap up, and then fall like it did out of the sky the other day. But it's really, really challenging to place trades against that kind of market because one, if you're working for a living, you're not going to be sitting there watching the chart whip around during the day. So anyway, interesting. Yeah.
Another thought or an interpretation to this percent of stocks slide. You can go back one.
Sure.
Just great, thanks. I mean, my interpretation is we have never had the situation that all markets go down because typically, I think 2008 or the starting of 2008 to 2009, there was the energy sector and the resource sector doing very well, and everything else got hammered. And then in 2001, you had the Nasdaq who did very strong, whereas everything else was collapsing, and now there's nothing left.
Yeah. Now, Michael, Michael, I think that's a really great observation, and I think that one of the things it ties back into is when the U.S. government and several other governments throughout the world started the quantitative easing, going back in 2007, 2008 time, or 2007, 2008 time frame, and started monkeying with the saying that there were some companies that's too big to fail and all kind of stuff, and kind of took out of the economic cycle the natural rhythm and natural schedule of when different sectors would start doing better depending on in the market cycle. That is also what we're seeing come home to roost also, because things got skewed away from where they should be happening, and I'm making quote signs as I say should that nobody can see, but should be happening in favor of the easy money that was coming from the quantitative easing. So path of least resistance right now. This is kind of something new I'm working on. Right now, I believe that the down arrow gets the vote for the week. Now we may get a little bit of a relief rally, but ultimately our path of least resistance is down. Here's an interesting chart, and I've updated this. This was as of 9 o'clock this morning. It may have gotten worse or better since then, but as you can see, the stocks have been basically. Here's the where for the year, how much these individual markets are down. I went back also and grabbed the high from 2015 to kind of give us also another picture into how close are the Dow Jones, the S&P, the NASDAQ to moving into what's defined as a bear market, which is a correction of over 20%. And as we can see, the Russell is not only in a bear market, but also deepening the bear market. And as of right now, I'm not seeing a lot to say, hey, it's a good time to basically just be in cash and wait. If you're going to only trade to the long side, be in cash and be diligent, persistent, have perseverance and patience, and fight the urge, that wanting that instantaneous gratification of, okay, I'm ready to trade now. Therefore, the market's got to do what I want it to do, because guess what? It won't. So Dave Thoreau mentions that be careful about getting over leveraged in either direction. The reversals can be staggering, as we've seen over the last 2 days. And Dorothy, I don't know if we'll take a look at the Chinese market. We may take a look at the what it's looking like on its ETF for the Shanghai market. But let's take a look at the stocks themselves.
What do you think? The Russell, will it test the 1,000 a little bit more? Because today it just went through, and now we see a little bit resistance.
Yeah, we shall see. We're going to be. We'll hit
it's kind of a magic number, 1,000. So maybe some traders or computers are programmed to step in.
Yeah, it'd be interesting to see what some of the quant computers will do. And Mike and Michael, you can jump in on this, but to see what they'll do if we hit some of those hard levels like the 1,000 on the Russell, if that will hit those, bounce up, and then accelerate additional selling to the downside. That'd be interesting to see. But what we got here on the S&P?
The Russell actually went down. I think the low for today on the Russell was about 983.
Yeah.
Yeah.
And so here's the S&P. Looking at it on a weekly chart, it looks pretty bad. No, we have found support here at the 1866 level. However, our indicators are still looking like like they want to continue to fall. The momentum indicator has really dropped. The momentum to the downside really took off this week, even to a greater extent. While we, you could say that we have a bit of a positive divergence on the TSI. We certainly do not on the internal momentum indicator. One of the things I was mentioning yesterday, as we had this really nice bullish Harami, where the body of yesterday's candle was inside the body of the candle before. That's a bullish Harami, which is a typical bullish reversal signal. However, as I mentioned last night on the market update, that momentum right there, yesterday's momentum, was actually lower than the day before, even though that appeared to be a really strong update. And so that kind of gave me a clue that, well, that strong update may not be as strong as it appears. And sure enough, we get more downside today based on overseas, based on some reports that came out of the government this morning. So right now, support is holding at the 1866 level, and will it continue to hold? We shall see. If we fall out of this level, then where is it likely to go? Again, stair stepping down, you've got some support here at the 1850 level, 1800 level, 17, and then we'll start dropping down into the 1700 to 1700, and this level here, 1577, is the highs back from 2007. Will we reach those? Right now we don't know, but we are only approximately 15% from that low, that high. And this is the support, Mike, that you were talking about potentially testing. Yes.
Yes. Yeah.
Okay. And if you want to see something,
just having my calculator in front of me, it's only 11% from where we are now.
Only 11%?
Yeah. So
Okay.
815.
Yeah, I've got about.
You wanna take 16?
Yeah, 1866 down to 1577.
That can't be 11%.
Yeah,
No.
I've got about 15.4.
Yeah, that's more accurate.
And so let's take a look at this on a monthly chart to see what's shaping up. It gives us a really good picture of, this is what Mike and I have been talking about for quite some time, this rounded top on the S&P that has been going on for many months. I mean, we could basically, if we pick this level here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. So somewhere between, I would say, 18 to 22 months, this rounded top has been going on. That is a slow rounding top, and which the slow rounding tops tend, when I say tend, there's a higher probability of it. It doesn't mean it has to happen, but they tend to fail more dramatically than these quick little tops like we see here. If we roll back to, here's another thing that's kind of interesting. If we roll back to 2007 and we take the top here, whoops, don't want that one. How much of a correction did the S&P go through from high to low in 2007 through the 2009? Well, that was a
55.
Yep, I got about 57%. Yeah, 55, 57. If we activate that and actually slide it forward, and again, I'm not saying this is going to happen, but I want to be aware of what could potentially happen. And activate that, move that all the way over here to the highs right there. That, if we get a similar type correction, we're talking about, somewhere here between 1200 and 1300 for a potential downside target, which would put us back here into a support or resistance or support zone that was a previous support zone. It's something I just, like I said, I would like to be, When might that happen? That would be, probably, probably 9 to 18 to 20, 24 months away if things continue to look the way they're looking right now. But that's how I use my technical analysis to kind of give me a projection, and to be aware with it. The good news is during that time frame, there will be numerous pops of somewhere between 10, sometimes up to 20% on the indices that can provide some upside trading. And so, but anyway, so don't be, the thing about it, the message is don't be discouraged, because oftentimes once that gets out of the way, that's when some of the larger opportunities start coming forth. And we know from history, the biggest gains tend to come after, if we can recognize, after a significant large correction. Isn't that right, Mike's?
Yes, indeed.
So let's go back over to, where am I? Okay. When I was talking about capitulation, I'll just talk about that a little bit really quick here. Here is the month, the weekly. We get a big down week in August 2015. Big drop out of the sky, and then followed up with another large drop out of the sky. But we get this rebound. So this was huge selling down to around a support level that we see over here, and then a rebound. We get a little bit more of it over here, but it just retested back to the same low. Same type of thing on a weekly chart. We see it back in October 2014, but those are the capitulation type moves that you're looking at, where you sell off really, really, really hard, but then it rebounds and price action closes back up in the upper half of the candlestick. And what oftentimes happens is you'll get a attempted capitulation like we see here that happened in September of 2014, but that's the first try, and it fakes us out, and then we go on for more selling, and then it takes place. So it's just to be watching those kind of market moves. NASDAQ, how's NASDAQ doing? On a daily chart, NASDAQ is dropping down to a lower level of support. Today's candlestick currently is a spinning top doji, which is a candlestick of indecision. It goes with, here we had a hammer that appeared to be a reversal signal, but it gives us a clue that buyers did come in, tried to push up, but the sellers took the reins of the market and pushed us back down, and then dropped us even more. Buyers again attempted to come back in yesterday, pushed up, and actually made a nice little return here. This is about a 4% top to bottom move, but then sellers came in overnight. Bad news, dropped the market down. And as we can see, the momentum itself has even fallen lower. A little bit of positive divergence on a daily chart, on a daily true strength indicator, and weekly wise, we're looking down. Mike, you got anything on the NASDAQ?
Well, nothing really you haven't pointed out. Again, I seem to mention it on a weekly basis. You look at, how far the price action's getting away from the moving averages, getting away to the downside.
Right.
And I also find it remarkable on all the indexes, once these broke below the 8-day EMA on the daily chart,
yep,
back around the first of the month, how well contained the price action has been by the 8 EMA
right,
ever since.
Right. And here we see the breakdown of that on the weekly chart. The 8 is dropped below the 20. The 20 is approximately the 50-day moving average, but as you can see here on the daily charts, the 50-day is just about to drop the 100, and then if we get the death cross, which is the 50 crossing the 200. Now I use exponential moving averages, the EMAs. They actually measure the death cross, if I'm not mistaken, with simple moving averages. And so on simple moving averages, this may have already crossed. Do you know if it has, Mike?
Yeah, it has, because I keep the simple moving averages on my charts, except for the 8.
Right.
And yeah. I mean, we have a death cross again on the S&P. Happened about a week and a half ago.
Yeah.
50 below the 200, and also seeing that the stack of the moving averages is pretty orderly to the downside.
Yes.
You know, they're properly stacked for a downtrend to the downside. The 8's below the 20, the 20's below the 50, the 50's below the 200.
Right.
And you know, we saw that situation persist for a very long time during the uptrend.
Right.
You know, during the market, and now that has reversed.
And the other thing I'll point out is look at the slope of these, you know, two moving averages, the 20 here on top, the 8 here. The slope has increased, therefore giving us, you know, letting us know that the velocity to the downside has also increased. And our big question is, where will we get the relief rally? We don't know at this point. I mean, it's got some good targets, like right here's a really good target, the 4100 level, but it's got some resistance at the 8, resistance at the 20, and so something to keep our eye on. So let's take a look at the Russell. Okay, the Russell is, as Michael pointed out, dropped the 1,000. It's at 994. Let's take a real quick look at the weekly chart on this, because as we can see, it is much closer to, you know, where's its potential target? Well, its potential target is back here again at the highs from 2011, but let's go back here to the highs of 2007, draw another little line in there like that, and that'll give us some idea. Matter of fact, it almost causes, it forms a really nice support zone, if you will. And how far are we from that area right now? Well, right now we are only, and again, these are approximate, about 12%. How fast can the Russell lose 12%? Well, this week it's lost about 13%. So I'm not going to say it's going to happen next week, but and then from here, from the highs down to that level would be a nice over a 30% correction. And but as we see here, the death crosses and all that kind of stuff took place on the Russell much earlier in the process. Here on the daily chart, it took back all the way back in November time frame, and then we got a little bit of a wedge up, and then it has gone. It is continuing to sink towards the bottom. And right now, if we do get a rebound here, we also have resistance level here at the 1052 level, which is this low here. And above that, we have resistance at about the 1078 level. That's where I would look for prices action stalling out and weakening if on just a simple dead cat bounce / relief rally. Mike or Michael, anything on this?
Yeah, well, you know, those levels of support that have been established in the past and have now been broken will certainly act as levels of resistance.
Right.
Going forward, I think another good thing to keep in mind, you know, a lot of the reading I've been doing, you know, a lot of the big investment banks, the Goldman Sachs, the JP Morgan,
right,
are putting out notices to their institutional clients now that we're in a rally, and I mean, we're in a market environment where rallies should be sold. You know, for years and years, buying the dips, you know, buying the little 4 and 5% corrections worked brilliantly. The banks and the institutions are now saying that that is not the thing to do anymore. When you get a rally back up to these areas of resistance, the institutions are going to be selling. And that kind of selling pressure is going to be hard to overcome and
Exactly.
probably be self-reinforcing. And I think that's what we can expect going forward.
And so, and Dorothy asked us to take a really quick look at the Chinese. There's the FXI, which I believe is the
Yeah, there was not that much movement. I think currently it's really the US, the hardest,
yeah.
where's the action comes from.
Well, you know what I think.
I know I have straddle in FXI, and I am astonished how little is happening there.
And so, yeah, I don't know how far back. Oh, there we go. Gets a little bit more picture. And this is the monthly on the right-hand side, weekly over here. I mean, it's got some, you know, additional downside, but again, this is a derivative of the actual Shanghai market or the Chinese market, and it's kind of interesting.
No, it's not. It's the Hong Kong market. FXI is the Hong Kong market. ASHR is the Shanghai market.
Okay. Well, this says China large cap. Is what?
Yeah, but these are the ones that are listed in Hong Kong.
Okay.
FXI, you can rely more or less on their financial reports, whereas
yeah.
ASHR, that's really the place where all the Chinese retail investors are putting their money.
I think Michael was right to an extent. The ASHR, which isn't really tradable here in the U.S., but I think it's a good proxy for the Shanghai Composite.
Okay.
FXI is the 25 largest of the large cap Chinese stocks, you know, wherever they're listed and traded. That's what that ETF is.
And one thing I think this chart really shows up is one, the huge volatility that is oftentimes apparent on this. We had let me increase that just a little bit. Big run up back in 2005 with the Chinese growth. This was almost all government manipulation, and then the government got back involved back in 2014, drove the market up here from this point. Up here was up about 44%, and then Mike Traeger and I were talking about that last May to say, hey, this is starting to fall apart, and actually we got in some good shorting type trades to the downside over here, and it has fallen now back down to a support level of about 43% drop, and it looks like it may in fact have further to go. I would be waiting for any time. I would like to see some of a rebound back up to the moving averages, but as you can see, this fell out of the sky and fell out of it hard. You know, how much has this affected the U.S. market? I don't know. You guys got any opinion on how much it's affected the U.S. market?
Well, my opinion is that it's had some effect, and there are other things that have also had an effect. It's not the only thing that's affecting the U.S. market.
Yeah.
But you know, we are in a global economy, and you know, certainly markets are interrelated and correlated, and you just can't get away from that. Even though we did sort of get away from that for a little while. Yeah.
I'm not seeing. You know, somebody Gary asked the question: is this, you know, is it related to the, you know, oil going out of the sky? I don't see that as much on the Chinese economy as because they're not big oil exporters or anything like that, or oil developers. I mean, they're trying to be, but I think it's just basically a combination of a lot of different things. Yeah, and they're each, you know, adding another layer of headwind, you know, for the U.S. market to run up against. Because I keep wondering occasionally also will people looking for safe places to invest eventually come back to the U.S. market? But the growth in the U.S. market right now is such with our companies, you know, is it a good place to invest? I question that, but eventually global investors will find what they believe is the safe haven. So let's move along.
Before we leave that last chart, there's one other observation I'd like to make. Can we go back one page?
I can. I just have to find it. There we go.
Okay, there's a guy I read who I get a lot of information from, who I write about in my articles sometimes, and he's done studies of financial bubbles in the past, and one of his observations or conclusions has been that when a market has gone into a bubble, and all bubbles are going to burst at some point, his observation is that the breaking of the bubble will take prices back to the base that was in place before the bubble occurred, or that the bubble arose from. And when you look at the monthly chart here on FXI,
right,
and if you will accept the notion that the Chinese market got into a bubble in early 2015,
okay,
that it came out of a base in 2014 and then just ramped up unsustainably. Well, we can see that this guy, John Hussman's observation has absolutely come true, that prices have now retreated back to the base from which the bubble arose, and so far even there you go. So, I try to extrapolate that to the U.S. markets. If you accept the notion that that we were in a bubble in the stock market here in the U.S., that the bubble peaked in the spring of last year when the all-time highs were put in on the indexes, where ultimately might index prices want to go to? Well, where did the bubble start coming from, before it got, out of control? And, it's just something to think about. I think it certainly has played out in the Chinese market.
Yep. Yeah, so, well, I hate to look over here in 2000, after 2007 and 8, where it dropped down here to 700 on the S&P, but
well, even here on the S&P, you can see an area of consolidation back around 2011, 2012. Consolidation, a base maybe in the 13 to 1400 area, and then things really started ramping up out of that base. And so the postulation is, will prices go back to where that base was established, back into the 13 or 1400 area? And there's a very good chance that that's exactly what's going to happen.
Great comment, Mike. And so to give you some idea, on the upside of the upside leg here from this breakout here, we're looking at about 26 months up to the top upper side of this. And so if the pattern has symmetry, or it's basically about the same, from about 1, 2, 3, 4, 5, about 7 months ago, you can measure measure out 26 months, 27 months, or even 20 months to give you some idea of when it might approach these levels here. So I'll be doing that over the weekend, taking a look at that. So let's move on, because we got to finish up. So I hope. Yeah. Judy says, Mike, that Hussman's observations may be really good, but his trading sucks. She said it's awful.
Well, yeah, his trading isn't great. His timing is great. But the overall bigger picture stuff that he puts out there is pretty logical and pretty interesting.
Okay.
Who's that guy?
John Hussman.
Okay.
John Hussman. Okay, let's just close things up. I just want to remind everybody that the active trend trading system is based on the 5 pillars of active trend trading. We basically what to trade, top quality IBD growth stocks, and index ETFs. One of the things that's interesting about the top quality IBD growth stocks is that the IBD 50 right now has been, because it is a computer generated list, the stocks that are actually getting onto the list, some of them are not real great growth stocks, and that's another clue that oftentimes happens when the market is really getting ready for a significant correction. And the index ETFs, when to enter, when to exit, what strategies to use and what to expect. Here's how we did in 2015. Beat the market, and I'm very pleased with that. I had about a 63. One of the things that I always, I'll just touch on this really quickly, is we target, around a 60% winning trades, win-loss ratio. And on the opposite side of that, that means that approximately 40% we will have a trade that didn't work. And I know that can be quite frustrating, especially in the current market environment, any market environment. But if this 60% it tends to be a very excellent target, and is reflective of Mark Douglas, who wrote Trading in the Zone. He talks a lot about trend trading systems, and he says that is a really good average to hit, to try to drive towards. But what that means is that there may be times when you're going to get 1, 2, 3, 4, 5, trades in a row. Sometimes it didn't work. And as we saw last year, by mid-year, we were sitting at about a 50% win-loss ratio. But knowing the system allowed us to know that, if we keep trading the system, that it will eventually come back to the averages that the system were designed around. Here's early warning alert performance for last year. Currently, I'm in the process of backtesting some downside trading opportunities to include those into the early warning alert service. And Mike and I did up a new early warning alert video, and it has been posted to the activetrendtrading.com website, and it's one of the just posts, and you can view that at the bottom of the page. Presentations going forward, monthly BAM meetings, and then the early warning alerts and updates are going on with the website as we speak. I think we've got all our 2015 data up to date on how we did in 2015. Excuse me. Active Trend Trading is we throw in 3 strategies on top of that, and I'll be tracking this year's performance with each one of the strategies. Strategy 1, stocks and index ETFs. Strategy 2, basic options, and strategy 3, owning leaps and then selling weekly options against that. On the website, it tells exactly what the 2 services are offered and what is included in those 2 services, with all the way from the text alerts or the email alerts. If you are a member of either and you are not getting the text alerts and want them, please email me and send me your mobile phone number with no hyphens, and we'll get you, and as long as you're in the US, we'll be able to get the text alerts going to you. So if you are watching this, we do offer a 40% discount on our monthly membership, and a 60% discount on our yearly membership for early warning alerts. You can find that at this website, at the website. So with that, we'll see you guys next week. The market is closed on Monday, so please enjoy your 3-day weekend. The Dennis. What's that, David? And Mike and Michael, thank you for joining today. Guys, I have time to look at about 2 stocks, and then we're going to call it a day. My granddaughter is here visiting, and so I'm going to go spend some time with her. So God bless everybody. Thanks, Mike. Thanks, Michael.
Thank you. Bye.
Okay, any stocks? Okay, one of the things, guys, if you're still online, that we're going to be looking at also is looking at those inverse index ETFs. I'm in the process of doing the back testing on those. With the market, perilously perched to continue to fall some additional. We'll be looking at some good setups for those. And oftentimes I've found it is Easier to trade the inverse index ETFs than it is to try to short stocks, because some, in an IRA and those kind of things, you can't short a stock really. And so if you don't want to trade options, that's one of the ways to participate to the downside if you choose to. And if you choose not to participate to the downside, that's fine. Cash right during current market conditions is a really good strategy. That way, once the market does start turning around, then you'll be ready to move in and start buying our positions as we build our portfolio. So with that, I'm going to call it a day, everybody. Have a great weekend.